statistical regressions in there. That's what we're going to do. And we're going to use, Nick.
Oh, I was just wondering, so, like, there's not 256 financial stocks in, like, the XLF fund, I guess. So where do they get all these
Because
stocks
the XLF
from?
is based on the S&P 500.
Right, so where are all these stocks from?
So there
15.
are three major S&P indices. There's actually more than that. There's S&P 500, which are 500 large cap companies. S&P 400, which are 400 mid cap, and then S&P 600, which are 600 small cap firms.
Okay.
Add all those up, you get the 1,500.
Okay.
So I use that as a larger universe. There's a couple of reasons. It gives you more choices, which you could say, increases your workload. So you thank me later. But the thing is, what do you do to get better statistical results?
Increase the data set.
Increase the size of your data set, right? So if we just use S&P 500, we won't necessarily get as good a set of results as we do with the 1,500, or at least at least on face of it. So a larger set, 1,500 items in your sample instead of 500, should be able to get better results from doing a regression type of analysis. Right. So let's see. And it also allows you the possibility of looking at just your sector doing this instead of all of it together. We'll discuss some of these nuances a little bit later. So let's see. Before we look at the screen here, in fact, let's do this. Let's go to here, and let's kind of set the stage for what we're doing. Okay. All right. We are going to be doing relative valuation. There's all kinds of ratios: price earnings, price to book value, price sales, enterprise value, and so forth. Let's just use, say, a price to sales ratio. And if you're wondering why not a price to earnings, it's not going to give you information if the firm has negative earnings. So it'll kick some firms out. No firm's going to have negative sales nor negative price. So we'll get ratios in every firm out there, right? It'll give us the entire sample. So we're going to look at price sales. Now, if we just had a list of companies like firm A, B, and C, and I did a price sales ratio right by it, and I said from high to low, the ratios are 5, 10, and 20, you'd be inclined to say, well, A looks like the better value because it costs us less per dollar of sales. So A must be undervalued and C must be overvalued, right? But the problem with that is it ignores that there might be a good reason why A is trading at such a low price to sales and C is trading at such a high price to sales, right? In other words, C might be doing really good. Investors are seeing that and they bid the price up, so it's trading at a high price per dollar of sales. And A might be doing really bad and people see it, and so they don't want to hold it. They've sold it off to the point it's trading at a low price of sales. So we want to add some more data that can help us determine if A is undervalued or if it's just an awful company trading at a low price for a good for a reason. And we want to know if C is overvalued, or maybe it's a good company trading at a high price because it's doing an outstanding job and investors see that, right? So we need some other information to go with this. So what kind of information? Well, companies should, in general, we'd expect that stock prices should be higher for firms that grow faster than firms that grow slower. So growth should be part of it. I'm going to put a positive down here, meaning that price sales should be a function of growth, and it should be a positive function. So firms with higher growth should have a higher price sales, lower growth, lower price sales, right? What else? Well, profitability. Let's just say profit. So I'll write all that up there. Firms that are more profitable should be trading at a higher price than firms that are less profitable. Should be trading at a higher price at firms that are losing money, right? So profit should be a positive function. if I'm generating tons of profit, should have a high price to sales ratio. So already we can see, C could be overvalued. It's trading at a really high price. It could also be a company that's growing fast and generating lots of profit. It could be the A is an undervalued company. Alternatively, it could be the A is growing super slow and is not generating much profit, right? And then lastly, we want to know about the risk of the firm. Firms that are exposed to greater risk should be worth less. So we should see a negative relationship there. Higher risk, lower valuation. Now, we're going to look at a couple of other things over here. I'm just going to say other stuff for right now. We'll think about that later. These are the main three, right? These are the big three. I always want these three in my analysis when I'm doing relative valuation. I always want at least one item per firm that reflects its growth, one per firm that reflects its profitability, and one per firm that reflects its risk, right? Now, what are we going to do with this stuff right here? Let's get rid of this guy. So what we're going to do with this is we are going to, in FactSet, we're going to use the screening tool to get all of this data right here, okay? We're going to get price sales. I'm going to put an I down here. I is going to be per company. So the S&P 1500 has 1,500 companies. So we're going to have 1,500 price sales ratios, one for each company. We're going to have 1,500 measures of growth, one for each company. 1,500 measures of profit, and the same thing for risk. And if we add some other variables in there, the same thing for them. And what we're going to do with this is move this data into Excel and start doing some regression analysis. It's like your EcoStats course kind of thing. And here's what it's going to look like. So, like I said, this says that price sales should be a function of these three variables right here. Again, ignore the other stuff for now. Why are you doing that? Higher growth and profit should give higher price sales, and a higher risk should lead to lower price sales. So we want to run a regression to see if that works out for them. So we're going to do the following. We're going to make price sales per company our dependent variable, the Y variable in our regression. And we're going to do a regression where we're going to get our coefficients, so intercept, and then our coefficient on growth. Same thing for profit, and the same thing for risk. So we're going to estimate a regression that looks something like that. And what we want in this regression is we want these betas, right? These 0, 1, 2, and 3. We want those items. You see where we're going with this, right?
Yeah, this is Gucci's class.
Right? I'm going to put a little caret or hat above each of these because these are taking that sample from the S&P 1500 and estimating these 4 coefficient values. Once we have those estimates, we're going to go back to the data for each company, and we're going to go and substitute in, like company 1, we're going to take company 1's growth rate, company 1's profitability, company 1's risk, and put it into that equation and compute what the price sales should be given those coefficient estimates, right? So we'll take the estimated equation and we'll use to compute what we're going to say is our predicted price sales ratio for each company. Let's call that, let's put a hat on that, right? This is what it should be. So compute a predicted price sales. And then what we want to do, next step, is we want to compare this predicted price sales We're going to do it for each company to the actual price sales ratio per company. So let's think about that right now. Let's see. Let me change this guy out. So let's say that we did the following. And let's say that we ran this regression and it told us for company number 1 in our sample that the predicted price sales, it should be trading at a price sales of 10. Right? In other words, given company 1's growth, profit, and risk, and our estimates of these 4 coefficients, we put all that together, we get a price sales of 10. That's where it should be. But we find out it's actually trading at 8. So it's costing us $8 in price for dollar sales. It should cost us 10. It's worth more than it cost. Overvalued or undervalued?
Under.
So,
It's undervalued.
it's under?
Undervalued.
Because it cost us actual less than it's worth. See what I'm getting at? So we would like to see the actual below the predicted. In other words, predicted is what it's worth. The actual is what it's going to cost us. I want to pay less than something's worth. So we're going to do a ratio. We're going to do actual to predicted, 8/10, or 0.8, meaning that stock or firm 1 looks like it's at 80% of its actual value. It's undervalued by 20%. Okay? I've got a second firm in my sample. It also has a predicted price sales of 10, but it's actually trading at 15 times sales. So when I do this one, I get, it's costing me $15 in price for dollar sales. It's only worth 10. That ratio is 1.5. It's 50% overvalued. So you can already see what's going to happen here. We're going to do this for every one of the 1,500. It sounds, it's going to be super easy. Once we get the data in there, you know, this is the whole reason you use a spreadsheet. Once you get one line done, you copy everything down, and it does all the other analysis for you. All right? You'll see. We're going to work our way all the way through this in just a bit.
Are we
The whole
gonna,
thing.
This might be, I don't know how I'm gonna word this. Am I gonna, when we find our 4 stocks,
Hmm?
are we gonna compare the risk of those stocks?
You're-
The combination of risk? Because I know I'm jumping like 4 steps ahead.
This is going to help you
bomb.
narrow down from like the 200 something stocks and industrials and 2 something in financials and all that to a more manageable group to look at. And a lot you can ignore because they look seriously overvalued.
So I'm just trying to kind of align this in my head. Are we gonna take the data and then, so like in the stats class when we did the regression analysis, we narrowed it down to a few, to like a small sample that had like statistically significant like
We might do a little bit of that.
values, or is that how we're gonna
class was that?
Not by the time we get to this point. We might
applied stats?
we might do that beforehand, but not once we get into Excel and use it. So there's gonna be several. What would you call it? We'll say some diagnostic test to see if everything looks like it's going in the right direction. Some usable results, not that firm 1 looks undervalued, but that we're getting usable results. We're gonna do some diagnostic testing as we work our way through it. So that's, I think that's kind of what they were doing in applied stats, and we'll kind of look at it in a similar way. The basic idea is going to be the same. The approach may be a bit different. So we'll do that. We'll do it for all 1,500. We'll sort it. So we'll sort it from low to high by this number right here, right? Because we want to find the undervalued stocks and avoid the overvalued stocks. And then that way it narrows your search down in your analysis once you start looking at financial ratios, everything else about the companies, their credit, or their debt capacity, things of that nature. You've got a manageable set of firms to look at. All right, so let's see. Let's now go back to FactSet and look at the screening tool, because we haven't done much with it this semester. So let me start up here. If you open up screening up here, and if you don't see it, you'll have to add it in, right, in the menu bar up at top. Have you guys got it on FactSet? Okay.
The spider web.
So what you want, make certain you're on equity and not one of the other tabs like ETF or any of that. You want equity. Just use the basic starter screen. Don't use, they've got some pre-packaged ones. We don't need any of those in here. Just use the starter. Now, in fact, I'm going to tell you something. Now, it automatically defaults to S&P 500. Let me give you a caveat here. I'm about to show you a little bit more than what you need to do, but in case you want to do some of this on your own from scratch all the way, let me kind of start back at the beginning a bit. So let's get rid of that. We want the 1500 and not the 500, right? So let's come up here and just type in, let it search for us, S&P 1500, and I see it down here, S&P Composite 1500. I don't want these, utilities are real, I want the entire 1500 index. So let's get that. And what that'll do is, down here it gives me my sample, the result is going to give the 1500 companies in that index. Okay, I don't need this up here, so you see this little arrow over here that lets me kind of bring this stuff up. So let me just do that, right, so we can see a bit more. This is the data it gives us by default. I don't want a lot of this.
Is that all the companies?
Yeah, well, I mean, it's
All that
showing
fits
that.
on the screen.
But if I go down here, you'll
Yeah.
see, right, it's going to be everything in here.
Perfect. How up to date is this?
It's current. I mean, some of the stuff is going to be like sales, comes off the most recent financials. Now, how current, I could go back, and let me show you real quick, Colby. If I click on sales, I could say, let's see, it's giving me last fiscal quarter. Okay, maybe I want something different. Maybe I want annual, and I want 10 years ago. So I can change it substantially up here. You've got a lot of you've got more flexibility than I need.
Should we keep it the same?
Yeah, for this, we just want the most recent results in here, okay? Now, I don't want the stock exchange, so I'm just gonna right click on it, I'm just gonna get rid of that. The more stuff you have in here, the slower it's gonna work. So it pays to kind of eliminate some things that aren't necessarily needed. I don't need this RBI CS economy, but what I do want is this. I want GICS, Government Information Classification System, in case you're really curious. And I want sector, okay? So you can't do anything with it over here, just add it in. And it may be worth doing this for some of you. Put in GICS, and you notice you get some choices here. Sector, that's the high level, like that's going to be like if we had healthcare, like healthcare sector. But in healthcare, there's medical device firms, there's biotech firms, there's pharmaceuticals, there's hospital management firms. So to get those, to figure out which is which, I'd want to break it down into industry or sub-industry. So I could put that up here. That might help me in my analysis later when I'm looking at the results for my sector. So I'm just going to put that in there. I'm not going to really use it today, but I might do it when as an analyst for my sector, I'm looking inside my sector at the results. Okay, if I wanted to do a price sales screen with profit, risk, and growth in it, those three things, let's put that up here. So I want to do a price to sales. It's just basic English language, and it's trying to anticipate what you're looking for, okay? So you can see I've got a couple of choices here. I've got price to sales, and it says FactSet fundamentals. And below that, I got price sales per share. It's the same thing, but it says fact set estimates. And then I got price sales, fact set market aggregates. So on these three right here, don't mess with the market aggregates. That's something different. But you've got fundamentals and estimates. So here's the difference in those two. When it says fundamentals, it's using historical data, something that's already happened. Okay? So it might, for example, use the current price divided by the most recent quarterly sales data. When you see estimates, it's taking the price and dividing it by forecast sales, right? So you can see the difference. So remember we talked about like trailing price ratios and forward price ratios. So the forward ones where it's using the denominator is an estimated value, a forecast value, fact set estimates. And we're doing the trailing ones, fact set fundamentals.
Dr. Jones, can you come here for 1 second?
I think I got the wrong one.
So I have 1,506 stocks. Is that the 1,500 composite index?
That actually sounds right.
Because yours says 1,500 and mine says 1,506.
Yeah, but you know what it probably is, Nick? I don't know why it's showing that for you, but there are, in the 500, there are 4 companies that have 2 classes of stock.
Okay.
So I suspect there's 6 companies in there that have dual
Okay.
stock. It's not something to worry about.
Okay.
You'll see it. For example, News Corp has stock, A and B class stock.
Yeah.
Fox has it.
Yep.
Google has it. So you've got at least 3 of them.
Yeah, I know.
And there are 3 other companies. I can't tell you. I should know what the 4th one is. I can't tell you what it is. I don't think that's going to be an issue for anybody, but don't worry about that. So let's just pick for now fact set fundamentals. And so when I click on it, it gives me this box here. What I want is the latest results. So I'm just going to pick quarterly, and it'll give me the most recent quarter up here. In fact, you can see latest fiscal quarter, and I'll simply add that in. All right, so you see right there. So that's my price sales ratios. Now, I want to get a measure of growth, profit, and risk, right? In fact, I might want to try several measures of each. So let's see, growth. What do I want for growth? If my ratio is price to sales, then optimally what I want is sales growth. Whatever is in my denominator of the ratio, I want growth for that. If I have price to earnings ratios, I want earnings growth. So let's look at sales growth. And again, I'm going to have a couple of choices. I've got fundamentals, which means some past period. And then I've got fact set estimates, forecast. Now, here's where it gets a little bit subjective. I know what a company's growth rate is in the past, right? We can look it up. We can measure it for some period of time. The estimates are someone's subjective estimates, what they think the company will do in sales growth over some future period. Which one should we use? We could try them both. Which one do you think is, if we said, which one do you think, price sales should be a positive function of growth, right? But one of those two, it should be, statistically, it should be a better result than the other. Should be like a stronger T statistic. Which one do you think?
Fundamentals,
How come?
because it's like concrete data, like
It is that.
exactly what.
But what is it about, if I said it's actually the estimates, why? Why should you get a better
Oh,
statistical result from the estimated growth going forward than the past growth?
Is it usually
because past isn't an indication of future success.
It's companies' stock prices are predictors, right? Why? Because they reflect estimated future cash flow, discounted back to today. So that means that really the expected growth rate should be more relevant than the past growth rate, right? They could have done really good in the past, but if they're not expected to grow very fast going forward, then so really I would really want to have the estimated growth up here, but I might try them both. So I'm going to put both of these in here. So let's just put in the latest fiscal year for using fundamentals, and I'm going to come up here again and say sales growth, and let's do this one, and let's see. So we've got sales growth, and let's do it for, I'll do annual. And let's see, down here it says, let's see, current unreported year. That should be this year, but if you want to make certain, you can hard code it and just put up here 2024, right? So it's giving me the growth estimates for this year. So, and those will still be estimates because we won't know what the actual growth is until we're in the next year, what this year's growth, okay? So annual growth, it's going to default up here saying current unreported year, which should be 2024 now, but you can set it at 2024 just in case. Let's put that in there. Now let me show you something. When you see the headers over here, you see the FE, fact set estimate. So when you see that, it's giving you the forecast stuff instead of the historical. Okay? So it's pretty easy to pick these two out. 1 year growth in sales, that's the historic one. FE growth, that's the forecast growth rate. All right, let's see. Let's get a profitability. There are a couple of things that we could use for that. Let's go back over here real quick. So growth is going to be growth in sales because that is this denominator down here. But profitability, I've got several things I could use. One would be return on equity, ROE. Another that I might try would be a profit margin. And I've got several margins. There's gross margins, there's operating margins, there's net margins. If we're doing this, and I'm using return on equity, a margin that's a good alternative to that would be your net margin. Basically your net income divided by sales, okay? So let's go back over here. I want ROE and I want net margin. I want those two things. You kind of see what I'm doing. I don't need like a bunch of growth estimates for the same firm and a bunch of profit estimates. I need one item. But sometimes some of these items won't work too well. I'm going to do some diagnostics to find out which one's going to work the best. That's what I'm going to base my regression on, is what's going to happen. So I'm kind of building up some choices for myself here. Okay, so let's get ROE, let's get net profit margin. So I can type in return on equity or just ROE. All right, so let's just use here return on average total equity, fundamentals. So I'm going to put that in for the most recent period. And let's put in our net profit margin. So net, they call it net income margin. All right, so net income margin, net profit margin. There we go. So those are in. So you kind of see it's starting to kind of extend out over here to the right. Okay. So we've got some measures of growth, some measures of profitability. I want risk. What would you guys use to measure risk in a firm?
Beta.
That's definitely a choice, right? We could also do the stock price standard deviation, how volatile the stock price is. In the past, at times, we've also said maybe debt ratios might be a measure of risk. They're a bit iffy though. So probably the best choices we could get here for risk would be either using an estimate of beta, or I'll just put a sigma, standard deviation of our stock price up here. Those are probably the two best measures you've got.
This might be. I have
You had another one?
no, I was gonna say something else. I was gonna say, wait, isn't standard deviation of stock just beta? And I was like, wait, that's
Not quite. It's in there,
Yeah,
but it's not
it's in
not
there.
quite the same. So let's see. Let's go and add these in. So beta. I'll type in beta, and it's going to give me several choices. The best one here is where it says relative to local index. So I'm going to click on that, and I've got two choices, 3 and 5 year. I found it doesn't often matter a whole lot. Let's just use the 3 year. That was the default. We'll go with that for now.
wait, what you?
You got it on the 5 year, you said?
So
Three
I
year,
just
3.
used the 3. If you're concerned, you could add that in there again. In fact, let's do
Sorry, I just wasn't.
beta. So we'll do it again, and click on relative. Oh, by the way, let me show you something real quick. What I just did. So let's escape out of there. So let's type in beta again. Now you notice something that's just happened. See this pound P, comma P8 up here? That wasn't there a moment ago. That is my 8th column, and it shows that I put that in there already. Right, you see this right here?
I'm just not getting that 3 year.
Oh, you need to go set it.
So you got to set that, right? So it says 3 year
Oh.
or 5 year. So I'm going to go and I'm going to put it in here twice. I'm going to give myself 3 year and 5 year. What's the difference? The period of time over which it's measuring the data to get the beta estimate. 5 years is going to include the pandemic, so I might get some weird results for some of the firms, right? That's why I kept it at 3 years instead. Back when we had the group that was in here during 2000 and 2021, they had a harder time at it because the pandemic messed everything up so bad, especially the year after, in measuring these things. All right, so we can do both of them in here. And just to show you, let's go over here to the right, 3 year beta, 5 year beta. All right, so you'll see exactly what you've got. Now, got that. Let's do stock price standard deviation. Now, there's not going to be something like that. We're going to have to build this one, okay? So let me show you how we can do that. Over here, if you noticed, one of the items it gave me was closing price, right? So let's click on that, and I'm going to do like I am in Excel. If you click on a formula, just double click on it, you see how it's highlighted it? There. I'm going to just do a Control C. I've copied it. So now I'm going to get out of that real quick. And let's see, just come over here, I think. There we go. I'm going to click back in this formula bar, and I'm going to Control V. I'm just going to paste that back in. But here's what I want to do. Where it's got apply function. In other words, I want to take the closing price for a number of days and get the standard deviation of it. How volatile was the closing price? So let's go to apply functions right here, and I can take a period of time and what's the average closing price, what's the median, the max, the min, what's the standard deviation. So I want that. So I'm going to click on standard deviation, we'll apply that, and now I get something different. It's asking me how many periods do I want to use to compute this. Let's just use a year. So 365. Actually, I'll be honest with you, that's going to be more than a year. There's about 250 trading days in a year, right? So I
There's
could
no
do,
weekends?
yeah, so, and holidays and so forth. So, but we'll just do 365 on here. It's not going to change it much. So there we go, and that will give me my standard deviation of my stock price over that period of time. Now, let me show you one other thing that's going to happen here when I do a formula. Look at the header for that last column. There's nothing there. If I click on it, you'll see what I just did. Standard deviation of my stock price, but if I click on that, it'll show me, okay. So, but what I need to do here is give it a header, so when I export this to Excel, I know what that data is. So if I click on the down arrow here, do a right click on it, you can see up here, edit heading, right? So just do that again. I'm gonna right click on the down arrow where the header's missing. I'm gonna do edit heading. I'm just gonna type in stock price standard deviation. Now I know what it is. So I can alter the headings for the other things if I want to. And then click on done. So I've got some basic data in here, right, that I can work with now.
Like, how come it's not popping out anything?
Say again?
How come the standard deviation row isn't actually popping anything out?
I don't know. Let's see.
Mine has numbers.
Well, mine doesn't.
Yeah, mine doesn't either.
Mine got numbers.
Let's do this again real quick. Let me. Is it doing it now? Nope. Okay.
Change the number repo to USD.
Well, I don't know if it was that. Let's see. Let's do closing price. Let's see. Let me just do it again. Do standard deviation. Do 250. On there. And add. Let's see, format. Yep, it's not doing it. Okay. Right, so that's how you can populate this. Let me close this real quick and bring up one that I already had put together. But now you guys can see how you can make your own on this, right? How you can put data in there, and you can keep going and add more stuff in. So let me go and show you. So up here, here's their folder icon in FactSet. So click on this and open it up. And inside, I don't want to save that. Inside the client folder, you will find the following. I just put it in there a little while ago. Valuation screen, spring 2024. Okay? So let's click on this and open it up. So this is what I said. What I just showed you guys is, you know, a little bit more detail than we needed. We don't need it. We can just use this thing right here and be fine with it. But if you want to put your own screens together anytime, that kind of gives you an idea how to do it.
Wait, what did you do?
So open folder,
Mm-hmm.
go to client, and then down here, you've got, let me just do that so you can see, valuation screen, spring 2024. We open that, double click on it, and it'll open it up. So let's see, let me get out of there. Okay, so you're gonna have all of this. It's gonna be a fair amount of stuff in there. All right, it's gonna look like this.
Mine's not open.
This is not?
Neither.
Yeah,
Mine's good.
It is?
Mine's good.
Valuation screen, spring 2024.
And yours is working?
Mine's working. Is it okay if I save?
What I would do saving it, if you want to save it in your personal folder.
Well, every time I go to save changes or no?
I'd say no. Just
Oh, okay.
open it up, and then if you want to save it, put a file name down
Yeah, just
here
leave you close to
and save it in your personal folder. That way you can do whatever manipulation you want to.
Oh, I don't know what's
Innocent
going on
of
around
everybody
here.
else. Go ahead.
Can I substitute ROA for ROE, or is ROA available in there?
It'll be in there.
Okay.
You can do it.
Because there's something interesting I want to do.
Okay.
I'll
Fair enough.
show it to you after class.
Is it still not loading up, Brody? It is coming up,
I got it, yeah. I just had to like exit out of it
and then back in.
Yeah.
Okay. If it may be because you had this brought up before, I saved it while we were in here, so that may be it. You may have to exit FactSet, go back in, and it should show up for you.
I just had trouble populating
Okay. Now, real quick, what I was just saying to Brett, what I would say for each of you guys is, you know, there's a client folder and a personal folder. So you open this up, and the first thing I would do is go over here to the disk icon and do Save As, and save it in your own personal folder, so that you can manipulate it however you want to, and it won't affect anybody else. All right, so I do that. You could copy it and make multiple copies of it, and do whatever you want, still preserve the original. So that'll kind of help you out, because if you keep it all in the client folder and you make a change to it, it's going to affect everybody else in here. If you guys did, and you'll be fighting each other without even realizing it. So make your own copies in your own personal folder. All right. So let's see. I've got my price sales trailing. I've got a couple of growth estimates. Right. I do have debt ratios up here as a measure of risk. Look at those in a minute. Debt to assets. I've got beta, stock price standard deviation. I don't know why it wasn't populated a minute ago for the other. I'll have to look at that. But we have it up here, right? Stock price standard deviation. There's my profit margin, ROE. I've got a couple of other things for that other stuff item that I had. You know, I said other things we could put in there. So we'll talk about those in a little bit. They'll apply more to the tech sectors and communication services, maybe to industrials than any of the others. So, but we'll see. We'll look at those towards the end. So,
What were total assets? What did you say? What will apply more to tech sector?
there are a couple of other things. I'm not going to mention them right now. Let's just go with the basic stuff we've been looking at for the moment. Okay. So, profitability, growth, risk. So, before you dump this you could dump it to Excel by hitting this down arrow right here where it says download to Excel, and it'll do an Excel file. I'm going to cancel it. I don't want it doing it. Right? And you'd open it and start doing some regression analysis. Before that, though, here's what's going to happen. Let me get...
You make that sound so dangerous. Said, here's what's gonna happen.
When you run this thing right here in Excel, and you're doing a basic regression in Excel, you would like to see that, for example, the beta 1 coefficient on growth is positive, right? You'd like to see that the coefficient beta 2 on profit is positive, because that's the predicted relationship we talked about. You'd like to see beta 3 on risk is negative, because that's the predicted relationship. You'd also like to see something else. You'd like to see that the t-statistics are significant for them. Remember that? So you don't want to just see the predicted signs, you want to see that the coefficients are statistically significant. Right? So you can see either large enough t-statistic or a p-value that's low enough. They're basically telling you the same thing. So you could just dump all that data into Excel and start running regressions, but I found FactSet can actually be a useful tool before we do that. And let me show you. If there's not much of a correlation between the data and the price sales ratio, it's not going to do you any good going into a regression. So we can avoid it. So before we go and import the stuff into Excel, let's go from results where we're at right now, let's go to the charting tool right by it, where you see the histogram. So click on charting, and it's going to give you all this. So here are the various charts we can do. The only chart that's going to be of any value to us is the scattergram, the scatter plot. So if I clicked on that, it'll bring up a scatter plot. Let's see,
You don't think a bar chart or something would be useful?
not for what I'm going to show you. We're looking at correlations. I want to see how two series relate to one another. So I need the scatter plot. All right, so let's see. I want to see if, like, some of my growth data items, they should have what, a positive relationship with the price sales ratio. So let's see. So I want my price sales ratio on my vertical axis, and I want, let's take one of my growth estimates. I've got historical, I've got trailing growth in sales, or actually no, that's 2024. Let's do this one here. There we go. So there's one of my growth estimates, right? I've got my fact set estimated growth period on period, so for the coming year. And over here under the little wrench, it's got a tool, shows regression line. I want to put that regression line in here so I can see what the relationship is. It's positive. That's what I want to see. Right? Because remember I said there should be a positive relationship between growth and the price sales ratio. We can see it here. So that looks good. What if I did, let's see, what if I want to see price sales versus my net income margin? That should also be a positive relationship. It is, but I've got some interesting things here. I've got some extreme outliers. Right, you see this big this cloud right here, but see these outliers over here? I've got a company that's got a net income margin of minus 713%. So sometimes you get these outliers and they can really mess up your results pretty bad. Let's say I wanted to get this VIR biotech out of the sample because I don't like that big outlier. It might be messing up the results. So net income margin minus 713. Let's go back to the results real quick. I'm going to filter them out. Here's how I'm going to do it. Go back to the results, go to net income margin. Let's go find it real quick. Here we go, net income margin. And I'm going to click on that and go down to filter. And just hover over filter and you can see what the min. Some company's sample has a net margin of minus 6,000, so about minus 7,000, right? So let's, yeah.
That's the one that I think we should.
Big bet. Angel
Let's just say minus 500,
Turning
right?
this into round
I don't want to
tables.
mess with these, but I want to keep my sample in here. But let's say minus 500. Let's get rid of those extreme outliers. Done.
That also gets rid of the second one, actually.
And you see what's happened here? See this little filter? So I know that column is filter. I've excluded out some items, trying to get rid of some extreme results. Let's go back and look at that chart again real quick. Right now it looks more like a reasonable cloud here. It's got some, I can see a little bit of a pattern in that cloud. I still have a couple of extreme numbers over here. I could get rid of these too. Regenx Bio and Arcus Bioscience. I could knock them out doing the same filter. So where I had it minus 500, I can make it.
Will it really
minus-
make that big of a difference?
It may
there's
not.
1,500 companies
It may
in that
not,
cloud.
and, well, an outlier could really bias this result if it's extreme enough. It can. So that's one of my diagnostic tests. I want to see that the pattern that I get here, or the slope of this line is the right slope. This is positive. I could have left it alone, but I might get a better result if I got rid of some of those really extreme values.
So
I'm not getting rid of a whole lot of them anyway.
would you want to get rid of pretty much everything like outside of that cloud?
It's
or-
kind of subjective.
Oh,
The big thing I'm looking for, like, what if the regression line had been negative, going the other way, before I did this? You could say, maybe I don't use this item, or maybe I do, but maybe it's the extreme results that are causing that negative slope, right? So, first thing I do before I said, let's just ignore negative net income margin is, let's get rid of some of the outliers. And that's where you say, how many do we get rid of? Kind of subjective. I'm going to pull them out until I get a result that looks like I want to get a positive relationship between price sales and net margin. When I get that positive result, maybe I'm good with it. So I might leave it alone. I'm going to leave this alone because I've got a positive result there. Okay, I've got a bunch of these in here, so let's just scroll up some, maybe. Do I? Should have more of these in here.
Okay. Blue Jet Airways is on the verge of some negative income margin.
Let's see, add component. Okay.
There's one that should be filtered out, but I'm not sure how to filter it out. It doesn't have the price sales ratio.
Okay. They shouldn't even be showing up in here then.
Oh, no, it's not. I'm talking about in the actual information, because
Okay.
I already downloaded it as
Okay.
well.
Yeah, we'll go through that in a bit. Let's see. Let's do a couple more. Let me put some more of these scatter plots up here. So I want to do add component. And I'll do this again here. Maybe. Hold on a minute. Let me go back. I'm gonna reload this. Every once in a while, this may be what was going on where we didn't get the data for standard deviation facts that will kind of flake out. And it's worth just reloading it real quick. All right, so I'm just going to open that back up again. And let's open up my copy. I'm also going to do this. I'm going to open up my copy of this thing so it doesn't mess with what you guys have.
NVIDIA is an outlier. We gotta get rid of it. Sorry.
Is it?
Yeah.
Oh no.
That's a positive outlier, but it's still an outlier.
Because of growth.
Yeah.
It's the one that's like towering over all.
It's a couple 100% growth estimate on there. Okay, so let's go back in here. All my charts have
I
disappeared.
mean, there's a reason we don't have NVIDIA. It was deemed overvalued.
It's a tech company.
We're gonna roll our
Oh,
eyes
yeah,
and
no.
go
Everything
on
he presented
Colby's
was overvalued,
presentation,
but.
Yeah. But the thing is, it's gonna stay overvalued for forever, technically.
So whenever Colby's presentation time comes up, we're just gonna roll our eyes and groan.
And just because it's overvalued,
Doesn't mean it's not worth it.
bingo.
Yeah.
And it doesn't mean it won't go up any further.
Oh, yeah, no. He decided
Especially
it wasn't
You could
worth
have
the
your
highest
way,
growth sector in the
You would
world.
check all of our sectors that just do the have like 30 stocks in tech.
Okay,
Say,
real
what do you
talk.
think
Let's
you-
think about the possibilities. If I just took all the money from y'all sector and I put it in tech, all right, we'd be skyrocketing.
Well, yeah, no, but how we do that isn't by adding more stocks to your sector, it's by overweighing your sector. So
Bingo.
we're going to take like
100%
100
XOK.
basis points from yours, 100 basis points from yours, 100 from everybody,
Whole thing.
and give it.
Well, we need to do really bad,
6 extra
really good, or
percent.
really, really awful. There wouldn't be much in between what they're.
No.
So if a recession hits, we're done for.
Yeah, pretty much.
Or if you choose the wrong stocks.
Yeah.
Or it's not just you. Well, no.
Can't really
If
go
you
wrong
choose
with some of the big
wrong
ones.
to present, and then we.
I'm scared to present Intel, but I'm curious what they have to offer. Especially if they partner with it. No, I don't.
starting to
I think
really
nothing
understand.
can save Intel's stock price.
So
Then
I don't
again-
really understand why they chose IPG and
Yeah. Yeah, it's because we were looking for undervalued. And
they're
sometimes
two are-
undervalued is undervalued for a reason.
Look, I bought Omnicom. I thought it was a great buy, to be honest with you. It's doing me some good.
Yeah, I mean, it's one of those. I'm looking at it and I'm like, it makes sense.
I mean,
Yeah.
I looked at its like sustainable growth rate, and that
We might not be doing,
that
Like
that would
EOG,
go.
which is my one underperformer, it looked great on paper.
Personally, I just like doing Forex.
shut up.
He's trying to pivot. He's trying to pivot. Somebody stop him.
We're not gonna let you do anything.
A small loan of $100,000.
Find a penny stock. Present a penny stock.
A penny stock. That's basically what it is.
Wait, who has
Not
Chipotle?
really, but-
Like, that's discretionary, right? They're planning on cutting it, like, I think it's 500, cutting one stock. They're planning to do, I believe it's a 1 to 500 split.
Okay, there we
on the
go.
stock.
All right, so
And
what
it's
I
up
was
to
showing
like
before.
$1,000 or $10,000.
Chipotle.
Oh, it's giving you different windows now.
And they still be skimping on my meat.
Yep. Well, no, that's why they get
Those
Bro, I don't know who you're getting. I get
$3,000 to buy a share of
Yeah.
Chipotle.
Okay, so I've got a bunch of scatter plots up
It was
here
some.
already.
Oh no, it's a 1 to 50.
So,
it wasn't 500.
um,
still.
How did you do that?
It's a huge.
You just double click on it, you can add more in. It wasn't doing it for me for some reason.
Will those export into
You may
Excel?
have to do what I close it and go back in. Yeah.
I'm sure we could make these in Excel. No, once we export all the
It's
data,
easier in here.
just
I
because it
know,
does
like,
it for
I
you.
put-
It's easier.
I clicked the little like 2
Um,
arrows to send it up, and you have to like put a little X.
Yeah, so
Hides
just double
it.
click, it puts you in a blank scatter plot. Put in price sales and then whatever you want to compare it to.
Can I ask what's the point of putting it in Excel if it already charts it for us?
So we're gonna do the regression in Excel.
Oh, okay.
We're gonna do that. We're gonna do the final analysis in Excel. These will make certain everything looks good. So real quick, I've got 2 profitability measures. I've got ROE and I've got net margin. There should be a positive relationship. That's what I want to find. And I've got that with both of these, right? You see how it's increasing from left to right? So I can use either one of those. One might ultimately do better than the other in my regression, but I could use either. I don't want to use them both, but I can use either. So Brett, when you're talking about can you use ROA? Yes, but the first thing you want to do is put that into FactSet as one of your columns. Come in here and test price sales versus ROA and see if you get a positive relationship. Right? Because otherwise, if you get negative, it's going to give you a negative coefficient in Excel when you do your regression, and you can't use that. All right, let's see. If I wanted to use debt, a debt ratio as a measure of risk, we've done that in the past. I would want to see a negative relationship between that and price sales, right? Higher risk, lower price sales. I do have it, but it's kind of shallow. There's not much relationship here. I get a little bit more using beta, right? See how it drops off a bit more here. So beta is probably going to do better than a debt ratio will do. I want to show you this. We did stock price standard deviation. Now I knew this was going to happen when we did it, so it's kind of a little bit of wasted effort, but I want to show you here. Here's price sales, stock price standard deviation. Look at what the regression line looks like. Higher stock price, higher volatility of stock price, higher price sales. It's contradictory, right? So what does that mean? It means I don't want to use that as a measure of risk in my regression. So instead of running the regression and finding out that I get a bizarre result, I'm using FactSet as a diagnostic tool to test this to see if I get this kind of relationship right here, right? I want a negative relationship with a risk measure. So that's why we're using this right here, okay? Let's see. Down here we've got I've got some growth measures. So sales growth, I want to see positive growth or growth affecting price sales positively, and I get a positive slope right here. And I had a couple of other measures of growth. So I had a historical measure. These all look good. So I've got some choices I can use here. Now let's go and let me sort from here. Let me dump this into Excel.
So would you take the standard deviation one?
I wouldn't use it. I'll leave that in there in the basic
Yeah.
file. But I'm not going to use it
Okay.
because it doesn't have the predicted sign. If it doesn't have the predicted sign, it's going to give me wonky results in a regression. I'm just going to leave it out. I want to. What I'm doing this is variable by variable. I want to see that my profitability ratios, that I have at least one that has a positive relationship. Same thing for growth, at least one with a positive relationship. and risk at least when it has a negative relationship.
So then did we look at
Let's see, let's try that again. Okay, you get this into Excel, it's gonna look like this. So I hit that. Let me just clean up a few things in here. I don't want those first 3 rows, and it gives you a row right here, a blank one. I'm gonna get rid of that. And let's do
but the
one.
3-year beta is also positive too.
Yeah, so we need. to
Yeah, so
decide
you could
here.
use presumably either one. In the regression, maybe one does better than the other, but you could use either one of them.
Beta or standard deviation?
Not standard deviation. Remember that had a contrary result, right? It was a positive relationship of that was saying that higher risk was valued when it should be the other way around.
Isn't that what the 3-year beta is?
Yeah, 3 years positive also.
Okay, so I got my data in Excel. Let me blow this up a little bit so you guys can see it better back there. Now, I'm going to do this. This is just a matter of personal choice for me, but I tend to do the following. I want to take the items that I'm going to use for my price sales and then all the regression variables, and it's going to be columns from over here, but I want to move them over here. I want to leave all this data intact, so I'm going to do the following. Let's set up a couple of columns here. This is where I'm going to put my data for my regressions, okay? So let's see. Right here, let's put in, this is going to be my price sales ratio, right here. And I'm going to go over here, just equals. I'm going to go grab it using a formula. So my price sales ratio is here. There we go. There's all my price sales. That's going to be my Y variable, my dependent variable in my regression, okay? Now I want a measure of growth, a measure of profit, and a measure of risk. Just one of each. And if I had multiple, I'm going to pick what I think might be the best of them. So growth, I'm just going to use the following. I prefer to use the forecast, so where it has FE growth, I'm going to use that one right there. The relationship is positive in fact set, so I'm going to use that one. And then for profit, the net margin and the ROE both work. I'm just going to use ROE. Okay, let's use that. And then for risk, the betas worked, so I'm going to use here. I'm going to use the 3-year beta. So I'm grabbing those. Copy that down. So there's the data I'm going to use in my regression right there. I'm leaving all the other stuff I ported in intact. So I'm just moving these. In Excel, you've got to have your 3 X variables, your dependent variables or independent variables side by side when you're doing this. It's just the way Excel works, okay? So Y, X1, X2, X3, that's all the data from my regression. Now before I do anything with this, I need to do a couple of checks. Let's see if I can find an example here. I'm not seeing it right away.
This.
Yeah, you know what I'm looking for, right
Yeah.
then? Okay, so let me show you real quick. Let's go over here to the raw data. You see all these n/A's? Or does it have any data? If I have any of that with what I just put over in those columns, it's not going to give me a regression. It's going to say non-numeric data. It can't do a regression on it. So we need to get that stuff out of there real quick. So let's go look at this. So what I'm going to do is the following. In fact, let me just do this. Let's go run a regression on this, and I'll show you what I'm getting at. So to run a regression, go to data, and over here you should see data analysis. And by the way, if you guys don't have that, you got to do the following. Go to File, go down to Options. In Options, go to Add-ins there. And then from Add-ins, you'll go down to Excel Add-ins, you'll click Go, and it brings up this. And you want to see that analysis toolbox is checked. You want that there. Otherwise, it won't bring up the analysis tool pack. Okay? So if you say I can't do a regression, it's not showing up, simply click on that and it'll show up.
Can you do it again?
Yeah. So to get that in there, go to File, down here to the bottom to Options. Inside there, go to Add-ins, right there. And then where it's got Manage and it's got Excel add-ins down here at the bottom, click Go. And you want to click on the very first thing where it's got Analysis Tool Pack.
Alright, thank you.
And then once you do that and you get out, you should see in Data, over here in the far right, you should see Data Analysis. So click on that guy. And if you scroll down a bit, you'll see Regression as one of the items you can do, one of the tools. So click on that. And your Y range is your price sales, okay? So let's go and click on it. Grab the first row with the header in it, all the way down to the bottom. And then your X range is going to be, click on all three of that. Click on the whole thing, okay? Growth, profit, and risk, click on it all. And over here, it's got a checkbox for labels. Since I clicked on the top row that had the labels in it, I want to click on labels right here. And then output range. Let's just put the output right over here, okay? I'm just taking something kind of a little off to the side. Now it's going to do something, I think. There it is. Input range contains non-numeric data. It can't give me regression coefficients. So let me show you what's going on. Get out of that. It's got some of these N/A's over here, and so it can't run a regression. It's got to have just numeric data in every one of these cells since I select. So how do I know? How can I find it? Let's do the following. If I click on just the data items there, where I should have data, you see at the bottom down here, I've got nothing. Let me show you something real quick. Let's see. If I clicked on just that right, it's not doing it. Why is it not? Okay, that's interesting. Have you guys got Excel up on your computers?
I don't. I'm on a tablet.
Okay.
I'm way behind you.
Where are you at right now, son?
I'm still doing the.
Well, you've got it in there, right?
Yeah.
Okay. So you could clean some of that up. You got the basic idea. You've got price sales. You're getting some of your X variables over here, right? Do this. Just grab like a selection of this real quick for me over here. This data. Yeah. Just grab several of those cells and kind of like grab and scroll. Okay. See how you've got like average, all this data down here, summary data.
Yeah. Oh.
You see what I'm getting at?
Yeah.
So if you guys grab some, it's not working for mine for some reason, but if you grab this right here, you want to see down here like average, count, max, min, all that, some summary data about the cells you're grabbing.
It's sometimes on the left side. That's how I check it.
Yeah, it wasn't showing it for me at all. At least I didn't see it.
What are we looking for?
Mine's only now.
Yeah,
it's
normally it'll say like cells selected. It'll say all that stuff.
I
That's
highlighted
interesting.
all of it,
Mm-hmm.
and it
Yeah, no,
stopped giving me all of the information. Like now, it only gives me the count once you select all of it.
Oh, but that's, okay, that's what I want to see. That's an indicator that you've got non-numeric data in there,
Oh, okay.
right? It can't average out
Yeah.
N/A, so you got non-numeric data.
I guess
So let me kind of just walk you through. So if you selected all of that data right there, ignoring the label cells at the top, you should have some data down here on this. It should be average, count, max, min, all that kind of stuff. But if it just gives you a count, then what it's happening is you've got some N/A's in here, and we need to get rid of them. So the easy way to do that is as follows. Let's select everything. Every column in all rows except for the first row. Okay? And go to sort, that's also in data, and I'm going to sort by price sales, column double A. And you see what just happened? It just dropped out an N/A. We had a company, this is what Ben was saying, Vista doesn't have a price sales ratio for some reason. So we can't run them in it. I'm going to get rid of that. So let's just dump them out. Vista may have been a good company, but we're not going to look at them now, right? I can do the exact same thing for the others. Now, don't grab just this right here, because if you do, when you sort, you're going to mess up the relationships. You'll misalign this data. So grab everything all the way across.
Wait, what did you do after you highlighted?
So, like I was saying, don't grab just that. That'll tell you if there's an N/A. But when you sort everything, grab all of this data right here so you can preserve the rows. You've got to keep everything in the rows intact, right? Each company has to keep their data
But
together.
yes, that is correct.
So, let's see. Let's just go through this real quick. Let's see if AB does that. Nothing showed up there. We'll do AC real quick. Nothing, and we'll do AD for the risk column. Okay, there we go. I've got an N/A. I didn't have a beta for this company right here for Arcadium. So I'm going to get rid of them. So they're gone. Now, if you got rid of those two companies and you select all this data over here again, you should get, I don't know why it's not doing it for me, you should get like the count, but you should also get the average, the max, and then all that kind of stuff. Are you seeing that, Nick, on yours? Okay. So we've got data that's all numeric and nothing but. We can go do the regressions now. So let's see what's going to happen here. Let's go do the regressions and let me finish this up. We're going to be a little bit late today, but not by too much. We're close to being done. I want you guys to kind of work on this stuff, and you'll have questions, come see me, right, on it. Let's see, let's go back and run the regressions on this stuff again. So I'm going to have to reselect this. There's my price sales, that is my Y range. My X range will be my growth, profit, and risk. Okay, make certain labels is checked, and let's put our output right over here to the side, right there. And good, since it had just numeric data, it could do the regression. And there's our regression results right there. I'm going to reduce the number of digits showing because that's kind of messy to me. So it helps when you've got OCD. So, I do have a problem with this too. Okay, there's a couple things I'm looking for in this regression. It's all down here. Don't worry about the other stuff. I can use the t-stats. I want significant regression coefficient. So I could use either t-stats or p-values, and to me, p-values are easier to use. I want to see numbers below 0.1 over here. Everything's significant. They're all below 0.1. So that's one thing. Then I want to come over here. Intercept I'm not worried about. But growth, that number needs to be positive. That's good. It's positive and it's statistically significant, okay? So growth is good. Profit should be positive, right? And significant. It is. So profit's good. Risk, significant, but it should be negative, and I've got a positive number here. I don't know why I've got a positive. I did the same data set a little while ago and it was negative. So,
It's because you're supposed to use the 5-year, not the 3-year.
did I have the 3? Let me go and change that. So, let's see. I used the 3 here, right? So, but this is a good example. I cannot use this regression because it's got a positive sign for risk and the relationship should be negative. So I can't use this. All right? So this is why I had several measures of risk. I'm going to go take out my 3-year beta, and like Ben said, I'm going to try the 5-year beta instead and see if that works. That's why I also have it referencing the data columns instead of copying them over. Okay, let's go find the 5-year beta. Here it is. Do that. Let's copy that down. I'm gonna have to run the regression again. So I've copied that 5-year beta over the 3-year, but I've got to run the regression again, okay? So let's go and do that real quick. You don't have to go do anything in here. Just click OK and let it run it over there. And that looks a lot better. Let's clean it up some. All right, so my regression coefficient's right here. Growth is positive, that's what I want, and it is significant. The p-value is below 0.1. Growth is good. Profit is positive, that's good, and it's significant. P-value is below 0.1. Risk is negative, that's what we want. P-value is significant, it's below 0.1. I can use that regression. That one's usable, okay? So here's what I want to do. I'm going to make a new column right here next to risk. We're going to call this, I'm just going to do E, expected, predicted. That's my predicted price sales ratio, okay? So let's see, let's just do that. So to make things easy, I'm going to do an equation here. So here's what I'm about to do. I want to take the coefficient for growth and multiply that by the growth rate for company A, for the first company. And then I want to take the profit coefficient, 0.009, multiply that by the profit measure for company A. And then the risk measure, minus 0.907, times the risk for company A. Add those products up and add in the intercept, and that's going to be my number right here. I'm going to do it for every one of these. So I want to make this easy. So here's the easiest way I found. Let's name these. Don't name this. Name the output right here for the coefficient estimate. This column right here. Let's name each one of these 4 items. So I'm just going to say intercept. No, that's not going to work too good. Interest C opt. Growth. Profit and risk. And here's why I'm doing this. Have you guys done that before? You've named these things in Excel? Okay, so come up here like you do a normal formula, equals, and then I'm not going to go reference the intercept coefficient. I'm going to type what I just put in. So I did intercept with an O, and then growth. So type growth, and it will reference that cell. And I'm going to multiply that by the growth number for that first company. And then plus profit, which will reference the profit coefficient in the regression, times my profit number for the first company. And then plus risk, so that'll reference the risk. Oops, what did I do wrong here?
Profit's not coming up.
Yeah, let's see what's going on here. Profit. That not go in? Okay, I just misspelled it again.
Is it gonna do that for each cell, or do you have to like individually name each cell?
No, so let me just get this real quick, and I'll give it just a second. So growth times that. Profit without I there times profitability for company A, and then risk times the risk measure. Okay, so do that just like you do in a formula. Just hit enter. There's the output. Okay, that says this company is well overvalued, or well, I'm sorry, that's what the predicted price sale should be, right? 4.39. We'll do that real quick. Center it. Now, all I need to do now is just copy that all the way down. That's what I was saying. This is going to be, once we get it for the first company, it's super simple. Just copy that formula all the way down. Just Control C and Control V it. You're done. Now what I want to do is I want to do that ratio. I want to compare the actual to the predicted to know if it's over or undervalued. So my actual is here, and I want to divide that number by my predicted number right here. So this is what it's worth. This first company should be trading at 4.4 times sales. It's trading at 9.5. That sounds like it's overvalued, right? So I'm going to do that column divided by that column. So I'm just going to put like under, over. Like, is this an undervalued or overvalued company? So equals actual divided by predicted. This company, this first one, is trading at 2.16 times its predicted value. It's overvalued by 116%. Like I did before, I'm just going to copy that down for all the others. Get it done for the first one, it's super simple. And let's see. So I can see right here, General Mills, I suspect, is going to be staple sector. So General Mills is trading at 50% of its predicted value. It looks undervalued, so it's at a 50% discount, it's 50% undervalued. Who is this? Gap. I suspect in the discretionary sector, this is saying that they're trading at 37% of their value, or alternatively, they're 63% undervalued, right? Century Aluminum, so certainly materials company that we're not actually using this term, but 107, they're 7% overvalued. Kind of close to being fair valued for them, right? So you see, like Kellogg, I suspect they're staples. They look seriously overvalued. Whereas Gap and General Mills look substantially undervalued. So I might be more inclined to look at Gap and General Mills than Kellogg. So it's going to focus my analysis. Now, it could be, no, we just had a couple of things here. It could be that Gap and General Mills are awful companies. There's something this didn't pick up that makes them really trade at a low value, right? But I kind of want to start with them and see if they look like good or bad companies. I don't want to start at the other end. I want to start at what looks like undervalued and see if they really are undervalued or see if they're junk. It's going to be one or the other. It's unlikely that Kellogg is going to be a good company. You never know, but it's not likely for that. Now, yeah, go ahead. Let's see, let's do one more thing real quick here. I've got almost 1,500 companies in there. I don't want to go through all 15. I want to look at my sector. So I'm going to do sorting one more time here. So the first thing I want to do, let me back out real quick and do this. This is why I put GICS sector in here. So we've got each of our sectors, right? Infotech, so forth and so on. So let's go and sort this first by sector. So column C. You can see it's lined all the sectors up. I'm going to go back up here and I'm going to add a sort level. So add a level, you sorted by sector first, now sort by this thing right here you just computed. You want to focus on the undervalued companies first. So let's sort it so it's undervalued to overvalued. It sorts from low to high on this ratio. So I want to take column AF and I want to do small to large, most undervalued to most overvalued. There we go. If we were tracking the utility sector, NRG is trading at, NRG is 16% of what is actually valued at, according to this, right? AES is at 30% of its true value. I want to focus here, but if I scroll down, I'm going to see like Next Era. This says Next Era is 73% overvalued, right? So I want to kind of ignore these and focus on those that look undervalued. Now, Colby, you may get some bizarre results in yours. Some companies that you think
I'm
are
curious. I want to see what it looks like. Can you scroll up
better.
there?
But there's some. That's where I said the other stuff, right? So I said
Okay.
your sector, Brett's sector, maybe Brody's sector and industrials. The other stuff might do. And that's gonna be some. That'll be a couple of other columns here we could add in.
More stuff to sort by.
It's a few of the predictors of value potentially. So let's see. Let's go up and look at. Well, let me do this here. Where
Uh-oh.
let's just do this. Click save. I'm going to bring up what I did earlier just to see if everything worked out okay. So there were earlier semester years ago I did this just on the fly. Let's just see how it goes, and it didn't turn out good. So okay.
That's interesting.
Here's where I threw some other data in. But let's see, for your sector, the reason I brought this up is, let's see, this is what I want right here. Here's the same analysis,
Oh, you did a bulk.
but I did some conditional averages up here where, you know, if it's like an infotech sector, what was the average price sales? By what amount was this over or undervalued? And this way I can tell like which sectors look to be the most overvalued in general and the most undervalued in general, right? And it kind of makes sense. Tech's been going up a good bit, so it's more likely to be overvalued according to this kind of analysis. And the ones that have suffered more are more likely to be undervalued. Real quick, when you see something like this,
That's real estate. Interesting.
when you see a negative, either in the predicted column or this over undervalued, don't mess with it. Negative, just treat like that's toxic waste. Ignore it, okay? You want lower, but you don't want to be low to where it's gone negative.
What do you assume that's from for real estate? Because real estate
It's-
also has the only thing that's up there with.
In a way, they're saying it's worthless, right? It should be trading at a zero price.
Interesting.
So that's why I'd say ignore that kind of thing. I think did I sort? No, I did not sort this. I sorted this slide here. Let's just go find yours super quick. And I'll show you guys one or two more things, and we'll get out of here. Here we go. Top of it, again, that one's got a negative number over here, so I want to ignore that one. Let's expand this a bit.
Arrow. I wonder who that is.
Which, the Solar Edge company?
No, Arrow.
Oh, down here?
Yeah.
Yeah, you may get some companies that you've never heard of in these, which would make sense because if they're less followed, it's more likely their price hasn't gone up to reflect what it should be worth. And you get some other companies you might think like Xerox. Are they really undervalued or are they just like a poor performer, right? That'll be some of your more fundamental analysis you guys will do. Like if you said, Xerox came in seriously undervalued, maybe I should propose them. You're going to do a deeper dive in there to see if they look good or not. So that's why we're doing this now, because following weeks we'll do the deep dive, see if the companies look like they're really undervalued or they're junk, and you will find another company instead. So that's going to be the next step for you guys after you do this. It's a tool to help you focus on which companies might be undervalued, but it won't tell you take the top four. It's going to say look there first, but they may be junk. You might have to drop down to another four and another four, right, until you find some good companies. It'll get you focused on this. A couple things. When you guys bring up that screen and fact set, you will find a couple pieces of additional information in there at the end. You will find, I tried these out today, you'll find cash and short-term investments. I divided this by total capital. You don't want cash and short-term investments because big companies will have more and small companies will have less. You want to put it into a financial ratio. So by total capital. I've got R&D expense over here. That's a total amount. So for example, NVIDIA is going to have a lot because they're a fairly big company. Supermicro is smaller, so they won't have as much. That may be a lot of R&D for their size. You can kind of see Supermicro by assets, it's a lot smaller company than NVIDIA, right? So I'm going to do a ratio for these things. Here's what I'm getting at. Companies in tech that are doing a lot of R&D, that should add value to them if what they're doing R&D and say AI is valued by the investment community. But it may not show up in the analysis we just did. So tech, comm, maybe industrials, R&D might be something to put in there, but as a ratio, you want to do R&D divided by total assets, something like that. So a financial ratio. So big companies otherwise would have lots of R&D and small companies small. We don't want that. We want it where which company has proportionately more R&D for its sales or for its assets, something like that. So that's what I did over here, where I had that other sheet, Colby, where I had, I didn't have assets when I downloaded this, so I did R&D divided by sales. Because I just didn't have assets, but I put assets in later. And then cash and non-operating assets to something, it may have been to sales as well.
Is it actually that low, or is it?
If you expand out the digits, there's data in there. It's just very small, is all.
Is it significant?
By the way, let me show you guys something real quick. When, for a lot of these companies, they had virtually no cash or no R&D, and you get a bunch of NAs. So instead of taking them out of the analysis, I dumped zeros in there. So you know how in Excel you can do find and replace?
Yeah.
Do find, pound, n/a, and replace it with a 0. You can do that for do it for cash and non-operating assets. Do it for R&D. Don't do it for the other stuff, but do it for those, okay? Just replace with this. They put an NA because they're saying they don't do any meaningful R&D. So just make it a 0, so it'll come out, so you'll be able to run it in regression. So the reason why I did that stuff is, let's see what happens down here. Let's go and take this data here, and let's see here. Oh, and if you see, I've got a bunch of companies with NAs. That's because those are all financials. I can't use that for them. That's not going to be anything that adds any value for financials. So let's see. Let's just sort by those columns. So it's basically I'm leaving out the financial sector. Okay, let's do this. Let me cut them out entirely there. Let's grab all of that. And let's do the same sort that I did a second ago. Let's sort by CNF. Okay. So you were curious about your sector. Let's see how it looks now, Colby, that I put those other couple of regression variables in. There's Solar Edge again. There's 0. So they are still in there. That's interesting. That didn't. Oh, well, I was looking at the same screen a moment ago, I guess.
This will be interesting to look at.
We'll look at this some more. Play around with it. You guys have questions, come see me. I was trying to think, there's one last thing I wanted to show you. So the reason why it's, we do 1500 is because you have a large sample. The more data you have, the greater the power of your test, and more likely if there's relationships to be found, you will find them and cut through all the noise. But that said, when you add a bunch of 11 different sectors, some behave very different from others. You might be mixing samples, so it might be the case that you might get better results looking at companies in just your sector and leaving out the rest of the S&P. So for example, Nick, you might just do the financial sector only from the 1,500 because you've got 240 something financial firms. You should still get good results just looking at them and ignore the rest of the S&P. Brody, you had there were like 200 something industrial firms. Could you do the same thing? Possibly. Now, if you do it and you find the regression coefficients are never significant or they have bizarre signs, when you cut it down to just your sector, go back to the big sample, right? But you could do that. If you say, well, I just did the big sample, I didn't do my sector, can I just go with those results? Absolutely. You can do that. But for some of the sectors like financials, you might try that with just your financial companies, Nick. That might be worth it to do that. And we can talk separate. There might be a couple of variables you put in there that they would not put in their sectors, like loan loss reserves or things of that nature that we've talked about. That wouldn't make any sense for a tech firm or discretionary firm or energy, but for your sector it makes all the sense in the world to do that. Okay, guys?
Also, even for the smaller ones, because I only have like 70 in the energy sector, and I was still able to run a significant regression for mine.
Yeah. Back when we had the S&P 500, we did that by sector. We did some that had like 23.
Oh yeah, with
by
23
con,
that one.
and it's just not enough to do it. Now, you still run the risk with 70. You may not get powerful enough results, but you're more likely to when you got a larger sample. So that's the whole idea. Right. There's a trade-off here. When you get companies in just your sector, they should be more alike, so you should get better results, but you got a smaller sample, that hurts you statistically. So you're trying to balance those two things, right? Power of the test from a larger sample versus data that should be in the sample versus data that should not be in the sample. We're trying to balance those two things. I think that's good enough for today. Attribution on Tuesday. There's no class on Thursday because it's Easter next week, but do this for me, guys. Work through this stuff, start digging on companies, and you're going to have questions, come see me, and we'll spend whatever time